This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stock market carnage. The Dow sheds 1,300 points in 2 days. The trading was volatile, it was turbulent, and it's leaving a lot of investors with a lot of questions.
Out of control, why the president isn't holding back in his criticism of the Federal Reserve.
Peak Permian. As interest rates rise, this is as good as it gets for the great American shale boom, perhaps. It's centered around an industry loaded with debt. Those stories and much more tonight on Nightly Business Report for this Thursday, October the 11th.
And good evening, everyone, and welcome. There is only one way to describe today: ugly. And there's only one way to describe the past 2 days: really ugly. The selling was widespread, the volume was heavy. The market has become gripped by fears of rapidly rising interest rates, a possible global economic slowdown, and high tech valuations. And according to one tally, this is now the worst start to a fourth quarter since 2008. The Dow Jones Industrial Average shed 545 points to 25,052. The Nasdaq fell 92 points, and the S&P 500 dropped 57. Bob Pisani at the New York Stock Exchange tells us what's behind the selling and what's getting hit the hardest.
Wall Street's steep Wednesday sell-off bled over into today, with the Dow tumbling almost 700 points at the lows before ending down about 500. Stocks were all over the map, moving between gains and losses in very choppy trading, but rates continue to be the main driver overall. The markets look to be holding steady until about 2:30 Eastern Time, when there was a huge burst of selling around some very big ETFs in the equity space and a burst of buying in Treasury bond ETFs. In other words, a rotation out of stocks and into bonds. What we're seeing is a momentum-driven flush out of some of the big cap names, and there were also a couple of sector-specific stories driving the action today. So, for example, bank stocks have been weak early on because of a weaker read on consumer prices. They were driven even lower by strong demand for treasuries at today's 30-year bond auction, all of which pushed bond yields down to session lows, generally negative for banks. And energy lagged on the day, falling on a bigger buildup than expected in U.S. crude oil inventories. And that was an issue for all the energy stocks. Tomorrow will be a key day to watch, with bank earnings kicking off, starting with J.P. Morgan and another big read on consumer sentiment. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, with all of the selling, we asked Mike Santoli to look for any clues about when this downward pressure might ease up. Here's what he found.
After a sharp and jarring market drop, investors quickly moved to assess the damage and search for signs of stability. And this process is now underway following the biggest two-day tumble since February. The damage has been swift and pervasive across the market, and the downside momentum has not yet let up. Traders are noting that the market has quickly become oversold, which means the indexes appear stretched far below their recent trend. Along with the fact that the vast majority of stocks are down more than 10% from their high in a short time, this can ultimately set the stage for a bounce simply as a technical matter. But sell-offs can feed on themselves as traders seek shelter from a more treacherous market action. One indicator getting a lot of attention is known as the Volatility Index, a measure of how urgently traders are buying protective options. This index has surged from 15 to the high 20s this week, an elevated level, but well below the extremes reached in February that marked the correction low. Veteran traders like to see this volatility gauge retreat dramatically from a peak over the course of a trading session, often a sign that the market is calming itself. Investor sentiment has turned cautious as well. Typically, a nasty decline spreads worry, which also can set the scene for an eventual recovery. One clue to when this market might find its footing is to see whether the majority of stocks participate in any relief rallies that pop up. While this skid in the market got rolling with a move to new multi-year highs in bond yields, it continued after yields stopped going up on Thursday, suggesting it had become a violent rotation out of some of the best performing tech, industrial, and consumer stocks as fears of rising rates, a possible profit slowdown, and unsettled global markets flared up. There's no reliable way to call an end to these ugly market episodes, but one consolation might be that the action is not clearly based on evidence of a weakening economy. This is mostly a stock market event tied to valuations and investor risk appetites for now, which means the market itself will have to tell us when these painful adjustments might be nearing an end. For Nightly Business Report, I'm Mike Santoli.
And now to the Fed, which is at the center of the concern over interest rates. Today, the president of the Kansas City Fed said the central bank will likely continue to raise interest rates. Esther George says a tightening labor market could lead inflation to accelerate over the next few years, though she added that the pace remains a matter of discussion. Separately, a new report showed a slowing of inflation last month. The consumer price index rose just 0.1%, which was less than expected.
And the president, as we've been reporting, has been a vocal critic of the Fed's monetary policy. He recently called the Fed's recent stance on interest rates too aggressive. But is it? Steve Leisman reports.
The president of the United States not holding back in his criticism of the Federal Reserve's interest rate hiking policies, blaming the recent stock market sell-off directly on the central bank.
I think the Fed is out of control. I think what they're doing is wrong. I think the Fed is far too stringent, and they're making a mistake, and it's not right. And it's, despite that, we're doing very well, but it's not necessary, in my opinion. And I think I know about it better than they do, believe me.
So is the Fed crazy? Before answering, it's worth pointing out 3 of the 4 members of the Fed's Board of Governors, the chair and the 2 vice chairs, were all appointed by President Trump. Beyond that, it's worth looking at how the Fed has changed its interest rate policy in the past year, largely in response to the president's own policies. Last year, the Fed forecast 2% inflation for 2018, 2% growth, and a 4.1% unemployment rate. The median forecast, as a result, looked for the Fed to raise interest rates by about 0.75 of a point to 2%. So what happened? Inflation came in right on target, but growth surged and unemployment came in well below the forecast. That is, the economy did better than the Fed expected. So the Fed changed its outlook. It now forecasts a full percentage point rate rise this year compared to 0.75 of a point or just 25 basis points in the prior forecast. Is that crazy? After a huge tax cut, a surge in the deficit, and a series of price-raising tariffs, most economists say the Fed is responding appropriately to the change in the economy.
There's a rate hike in December in its forecast. It has 3 rate hikes next year. My guess is actually the inflation numbers will push the Fed to 4. But none of that's a disaster as long as companies are generating profits.
The danger is if the economy doesn't keep up its momentum. In that case, the Fed's forecast could be too aggressive. But it can always dial back its plan to raise rates if the economy weakens. That's not crazy. That's monetary policy. For Nightly Business Report, I'm Steve Leisman.
Joining us now to help put all of this into perspective, joining us tonight is Andres Garcia. He's founder and CEO of Zoe Financial. Andres, always good to see you. Thanks for joining us tonight.
Thanks for having me.
So the sell-off this week essentially has wiped out gains we'd seen over the last 3 months in the stock market here in the U.S. So now what? Put this in perspective for us.
Okay, so the first things that I would mention is we're still, 5% from all-time highs, right? So let's take a deep breath. Another thing that's important to keep in mind is we've had 23 corrections that are 5% or more since March of 2009. So this is not an everyday event, but is not totally abnormal. I'll give you one more stat. If you go back 39 years, on average, if you look at the worst intra-year drop, is 13%. So even if we actually continue to see this, 5-6% correction turn into a 10% correction, that is still considered normal when we looked at the last 4 decades, right? So that's important to keep in mind. I don't know what's going to happen next, and I think that's important to keep in mind as well. Nobody does. So if it's out of your control, try to basically not focus too much on the headlines and stay focused on the long term.
All right. So what is the best advice then for our viewers who are watching tonight? Because, interest rates have been edging up gradually, but all of a sudden it seems to be what the market is focused on. So if you have a long-term time horizon, what is your best strategy to keep all this volatility in perspective?
Yeah, I think that's the key. And I'll say one more thing about the interest rates as well. Let's not forget that interest rates, long-term interest rates and short-term interest rates have been rising for a while. In fact, long-term interest rates have been rising since last summer, and last time I checked, the S&P 500 has been up since then. The other kind of headline that I see is that trade wars are creating this. Last time I checked, trade wars have been ongoing for this year, and the market's still up 5%, and it was up 10% when this trade war situation was pretty rough. But going back to your question, what is under people's control is how much they save, do they invest, And do they have a plan for the long term? That's under their control. And then the last thing that's under their control is how they react to short-term volatility. If you keep control of those things in the long term, you'll be okay.
Very quickly, technology stocks have been the darling of this market. The FANG stocks have been getting a lot of the attention in the last couple of years, and they're leading this market lower. What do you do with those guys?
I'm not going to comment on short-term volatility on tech stocks. What I would say is that their volatility in general tends to be much higher than the overall market. So people forget that they were up 50, 60%. They feel it more when they're down 15 or 20, right? So higher risk, higher return, and that's just in essence what you're getting when you're investing in those type of stocks.
One of the sacrosanct laws of Wall Street: higher the risk, the higher the gains. Andres Garcia with Zoe Financial. Always good to see you. Thanks for joining us tonight.
Thanks for having me.
It is time to take a look at some of today's upgrades and downgrades. Lear was upgraded to buy from neutral at Goldman Sachs. The analyst cites solid free cash flow and the potential to gain market share. The price target is $195. Shares of Lear rose nearly 2% to $137.54. The price target for shares of the New York Times was increased to $32 at J.P. Morgan. The analyst there expects the upcoming elections to help drive its paper's digital subscriptions. The firm maintains its overweight rating. The New York Times shares rose a fraction to $24.84. And J.P. Morgan cut the price target on Abercrombie & Fitch to 16. The analyst cites potential margin pressure as a result of tariffs and higher wages. The rating remains underweight. The shares finished down more than 5% to $17.99.
Still ahead, tipping point. Money had been flowing into passive investments like ETFs and mutual funds, but is that starting to shift?
A group of senators are not pleased with Google. Today, they sent a letter to the company criticizing it for failing to disclose the data vulnerability that affected hundreds of thousands of Google Plus users. Senator Thune said he was disappointed that Google's chief privacy officer testified before the Commerce Committee a few weeks ago and failed to provide information on that breach. Google disclosed the breach after it was reported by the Wall Street Journal.
And as we have been reporting, of course, the NASDAQ sell-off has been sharp. The index is off more than 9% from its most recent highs in August. And, of course, it is loaded with some very popular technology stocks, which begs the question, will this group that led the market higher now lead it lower? Josh Lipton takes a look at what may be next.
High flyers have been losing altitude. That's the story of big tech's recent performance in the stock market that has seen names like Alphabet, Amazon, and Netflix fall sharply from their recent highs. Many on Wall Street say the reason for the decline is simple. When there is a broad, sharp sell-off, investors tend to sell what has been performing the best. And that's especially true when the winners are some of the biggest, most liquid names in the market. But a major concern is whether there's a broader rotation happening from sectors with significant growth potential to those that appear cheaper and more defensive. If that's the case, it would be bad news for tech in the quarters ahead.
Right now, you have a lot of other crosswinds that are scaring investors, so this may last a little while longer as people get more comfortable with what goes on in tariffs, inflation, and rates.
Still, there are plenty of tech bulls on Wall Street. For example, the team at CFRA Research remains bullish on the tech sector. Next year, they estimate earnings growth of 11% and revenue growth of 9%, both better than the broader market. For Nightly Business Report, I'm Josh Lipton, San Francisco.
So with all of that selling on Wall Street and money flowing out of passive investments like ETFs and mutual funds, is this setting the stage for the comeback of active investing? Amanda Agati is the co-chief investment strategist at PNC Financial, and she's here to share her thoughts with us. Good to see you, Amanda. Welcome.
Thank you for having me.
You make the point in the notes that I'm reading here that you are starting to see that, and it's been going on for a little bit now.
Well, yes, absolutely. We believe very strongly that a comeback or a resurgence in active management is already occurring. It's not just precipitated by the last couple of days of spike in volatility in the markets. And actually, the backdrop for active management has been evolving and improving basically over the course of 2018. So, yes, we think that it's already underway and likely to pick up steam.
But you know why people were rushing to the passive investments, the exchange-traded funds, the index funds. They're cheaper. The fees are much cheaper. It's more expensive to invest with an actively managed fund. So what's the argument to go back to the actively managed funds?
Well, I think really we believe strongly that the mix of active and passive that we employ in portfolios should evolve as the cycle evolves. And so the rush towards passive investing has really been born out of the cycle that we've been in really since the financial crisis, where it's been very long, slow, sluggish growth. And with this as a backdrop, we've seen very high correlations among stocks, so large swaths of the market moving together. Volatility near record lows, if not at record lows, over extended periods of time. And then with the highly accommodative monetary policy stance out of the Fed, it's really made for a backdrop of very easy access to cheap capital for companies. And so it really hasn't created a backdrop to easily distinguish between winners and losers from a stock picking perspective. So we think all of these trends are reversing course now.
So are you telling your clients to have a mix of both active and passive?
Yes, absolutely. So we believe strongly that depending on the cycle and also depending on the asset class mix, the mix of active and passive can be different in every client's portfolio. So we're not fully recommending 100% passive in portfolios, just as we wouldn't recommend 100% active exposure as well. There really is very much a mix.
All right. On that note, Amanda Agati, thank you. Amanda is with PNC Financial.
Thank you.
Soaring demand helps Delta's profits fly high, and that's where we begin tonight's Market Focus. The airline said today that the higher ticket prices and stronger sales for its premium seats nearly offset the rise in its jet fuel costs. Delta also managed to keep a tight lid on other costs as well, leading to an overall earnings beat. And when it comes to rising rates, Delta thinks it stands to benefit as well.
The demand is healthy. We're looking at another 8% growth in Q4 in terms of top line growth. So demand is continuing strong. At Delta, we've paid down the vast majority of our debt. We got our investment grade rating back. Our debt levels at arguably our lowest level in our history. We also still have a pension liability. And as interest rates climb, it actually causes the pension liability to come down. So we'll probably be a net beneficiary on the balance sheet from a rise in rates.
Delta shares took off, up more than 3% today to $51.48. Meantime, Lockheed Martin's F-35 fighter jets have been temporarily grounded. The Pentagon says that fuel tubes are being examined after one of the Joint Strike Fighter jets crashed last month in South Carolina. The F-35 is the most expensive weapon system in the U.S. military. The inspection of the 320 jets currently in operation is expected to be completed in 2 days. Lockheed shares were down 3% to $326.26.
PayPal is teaming up with Walmart to provide financial services and products to their shared customers. The program will mark the first time PayPal's mobile app users will be able to take cash out of their PayPal accounts in a brick-and-mortar environment. PayPal shares rose a fraction to $75.90. Meanwhile, shares of Walmart were down nearly 2% to $93.92. RH, the retailer formerly known as Restoration Hardware, plans to buy back up to $700 million worth of shares. In a statement, the CEO of the home furnishings company says he believes the stock is undervalued, and the repurchase reflects confidence in the business. Shares of RH climbed 10% to $118.62.
Walgreens Boots Alliance today became the first Dow component to report its earnings for this season. And while the company's not facing direct headwinds from China or rising interest rates, it is trying to overcome challenges of its own. Bertha Coombs takes a look at Walgreens' mixed quarter.
Walgreens earnings results topped analyst expectations despite disappointing revenues, driven in part by strong prescription volume growth. The company says its share of the U.S. prescription market is now about 22%, thanks in part to the closing of its deal to buy more than 1,900 Rite Aid stores earlier this year. But the firm's chief financial officer admitted that profit margins on specialty drugs were down year over year due to lower reimbursement. Pharmacy benefit managers and insurers have been driving harder bargains on brand-name drug prices. The drugstore's overall retail sales were down from a year ago, in part because they purposely de-emphasized cigarette sales as they shift their focus. Quote, "We think we've done a good job in terms of shifting the emphasis to become more of a health, beauty, wellness expert," co-COO Alex Gorley told analysts, adding that there's a lot more to go. To that end, Walgreens is expanding its relationship with LabCorp. They're going to be bringing more blood testing to 600 of their stores. It's a strategic partnership with a likely CVS-Aetna merger poised to ramp up the competition in drugstore clinics with more integrated offerings. For Nightly Business Report, I'm Bertha Coombs, New York.
Coming up, is there trouble in the Permian?
I'm Brian Sullivan in the capital of the shale oil boom, Midland, Texas, where the combination of low interest rates and higher oil prices have been great for the industry. But coming up on Nightly Business Report, why many are concerned that if rates keep rising, all the debt that this industry is based on will come back to haunt it.
It's your favorite segment. Here's what to watch for tomorrow. Earnings from JP Morgan, Citigroup, and Wells Fargo are due. Attention will be paid to loan growth and interest margins. And with the central bank rates and inflation in focus, investors will listen to what a number of Fed officials have to say about the economy tomorrow as well. And we'll get a fresh read on consumer sentiment, which has been a driving force behind spending. And that's what we're watching for on Friday.
The Postal Service is proposing the biggest stamp price hike in its history to help shore up its finances. Under the proposal, the cost of a Forever stamp would rise from 50 cents to 55 cents. The request from the USPS Board of Governors must first be approved by the Postal Regulatory Commission.
Well, starting in January, Social Security recipients will see their biggest pay raise in 7 years. Beneficiaries will receive a cost of living adjustment of 2.8% for 2019. For the average Social Security recipient, that works out to an increase of $39 a month. The annual adjustment is based on changes in the so-called Consumer Price Index. It affects roughly 1 in 5 Americans, including disabled veterans and federal retirees.
Oil prices slumped to more than 2-week lows as global stock markets fell, and the government reported a bigger than expected build in crude inventories. The price of domestic crude settled just above $70 a barrel. That drop in oil prices, coupled with rising rates, is putting pressure on the country's shale producers, many of them located in the Permian Basin in Texas. And that is where we find Brian Sullivan tonight.
Here in West Texas, long-timers in the oil and gas business will tell you the industry is really built on 3 things: rock, people, and money. The Permian Basin of Texas, the richest oil area in America, has plenty of the first, but always needs more of the other 2. And that's why some people are beginning to question if the great American shale oil boom has reached a peak. So-called good rock is plentiful here. It's estimated there are tens of billions of barrels of oil just waiting to be sucked out of the ground. But to do that, you need the oil and gas workers to do the job, something that is increasingly harder to come by in a city 500 miles west of Houston with one of the hottest real estate markets in the country.
Getting people to come here, particularly if you need them to move here, is a difficult challenge. Obviously, real estate, particularly troublesome in that housing is very, very expensive, more expensive here than Houston or Dallas or someplace like that. And so for younger families trying to come here and start up, that's a lot to ask.
Locals have told us that some houses will sell in less than 24 hours. Some workers live in hotels, where rates can be eye-popping. A hotel like this can run nearly $400 per night. But the biggest concern about the shale boom on Wall Street is not people, it is debt. Moody's estimates that some $240 billion of oil and gas company debt will mature in the next 5 years, with nearly $100 billion of that alone coming from the exploration and production companies. We asked the head of research at Simmons Piper Jaffray about the impact rising rates could have on the industry.
Of course they matter. Actually, a collective balance sheet of the upstream sector with regard to E&P and oil service is in much better shape than it's been in a long time. Companies are living with a much closer, proximity of cash flow, and there's been true capital allocation reform. So effectively, I think that was a germane argument 2 or 3 years ago when the E&P companies were living well outside of cash flow. But today, coupled with pretty responsible balance sheets and living within much closer proximity of cash flow, I don't think is nearly as alarming as it could have been.
A few years ago, many oil and gas companies had almost no free cash flow. Now they've gotten smarter and they've cleaned up their balance sheets. Low interest rates and higher oil prices have been a great combination for the industry. But if rates keep moving higher and oil prices fall due to a slowing economy, the booming shale oil industry and the boom town of Midland, Texas, could find itself between a good rock and a hard place. For Nightly Business Report, Brian Sullivan, Midland, Texas.
And before we go, another look at the day on Wall Street. Another sell-off. The Dow down 545 points. The Nasdaq was down 92. The S&P was down 57. And don't forget, we've got those bank earnings starting tomorrow. It should be a very interesting day again.
We will see what Friday holds. We hope you'll join us for that tomorrow night. Meantime, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.